Hi everybody, Alex here from LFIS. Thanks for joining me in another episode of our weekly macro overview series. So another interesting week and we'll just jump straight into it. So firstly, looking at Europe, the first topic we'll cover this week regards the ongoing impact of the Russia-Ukraine conflict on global markets. Yield on Germany's 10-year Bund, a barometer for Eurozone borrowing costs, rose this week, signalling a sharp fall in the price of debt across the Eurozone. The ECB also decided to cut monthly purchases of government bonds to 20 billion euros by June instead of October, as previously planned, highlighting ECB officials' focus on taming inflation. There's also speculation around the ECB plans to raise interest rates by the end of the year, according to the head of European fixed income at Franklin Templeton. As we've discussed in previous videos, rising inflation in the US and Eurozone have placed significant political pressure on central bank officials to tighten monetary policy conditions, following pursuing loose monetary policies since March 2020. On a day of extraordinary volatility, the international benchmark Brent crude oil surged to a high of $128 a barrel, a level last hit over 14 years ago, before settling at the end of the week at $112 a barrel. Oil leapt after US President Joe Biden's administration signaled that it was open to freezing Russian oil imports, setting aside initial reservations over the hit to consumers. But the price fell back after Germany's Chancellor Olaf Scholz expressed reluctancy to restrict trade of essential importance to Europe's economy. Also, the ongoing conflict has affected the labour market and worsened global supply chains. Russia and Ukraine account for 275,000 of the world's 1.9 million commercial seafarers. Ukraine itself provides 5.4% of the officers that head the crews on over 74,000 ships trading internationally. This comes as Ukraine's President Zelensky urges citizens to stay at home and take up arms. And as a result, shipping executives have warned of shortages of vital staff that keep world trade moving. The chair of the Marine Transport Workers Trade Union of Ukraine estimates that 55 to 60% of Ukraine's 80,000 or so seafarers are currently on ships, and of those at sea, roughly 20% would like to return home and fight. Now looking at the US, so last month US consumer prices approached near 8%, mainly due to a spike in oil prices following Russia's invasion of Ukraine, putting further pressure on Federal Reserve officials to tighten monetary policy later this month. According to the Bureau of Labor Statistics, the consumer price index climbed 0.8% between January and February, following a 0.6% gain the previous month. This has mainly been driven by higher energy, food, and shelter costs. Prices are up 7.9% from a year ago, the biggest yearly increase since January 1982. And after removing highly volatile categories such as food and energy, the core CPI increased by 6.4% year over year. The most recent study covers the period right before Russia started a full-scale invasion of Ukraine, and Western partners released some of the harshest economic sanctions ever imposed on a country, including a US ban of Russian energy imports. On Tuesday, a market indicator of how hot investors expect inflation to run hit its highest level since 2014. The 5-year forward rate, a measure of inflation expectations for the next 5 years from now, reached 2.5%. And before Russia's invasion of Ukraine, the same measure was at 2.1%. This caused commodities to subsequently skyrocket during the week. Traders have largely expected inflation to remain elevated over the next year or two before receding on pressures of global supply chains, but those longer-term forecasts have rapidly shifted as the price of Brent crude and the international oil benchmark escalated to a 14-year high this week, and commodities including nickel, wheat, and natural gas have also rocketed. Finally, in the Americas, the G7 nations said on Friday that normal trade contracts with Russia would be terminated as part of a slew of new sanctions aiming at punishing Moscow for its invasion. The joint measures initially proposed by President Joe Biden included withdrawing Russia's most favored nation designation, which allowed Russia to trade products with many Western countries on advantageous terms under WTO regulations. Many Russian products will face increased tariffs because of this move. Other measures agreed upon by the G7 countries include prohibiting Russia from receiving any funding from the international organizations such as the IMF or World Bank. While the penalties vary per country, the US and EU have indicated that they would prohibit the export of luxury items to Russia and place additional restrictions on Russia's elites. Beyond energy, the US will establish legal authorization for investment banks in any sector of Russia's economy. The statement comes after the US prohibited Russian energy imports into the country earlier this week, affecting the two countries' largest economic partner and a major source of hard money from Moscow. The United States has issued an embargo on important Russian imports such as seafood, alcoholic beverages, and diamonds, while Brussels has imposed a ban on vital iron and steel items. Finally, looking at Asia. So next month, the finance minister the finance minister of Sri Lanka will travel to Washington in mid-April to present Sri Lanka's proposal to senior IMF officials. Sri Lanka has piled up over $12 billion in worth of debt through international sovereign bonds and must repay roughly $4 billion in foreign debt this year alone, including over $1 billion in ISB maturing in July. However, Central Bank Governor Ajis Sabral said that the goal is not debt restructuring. The intention is to discuss with the IMF plans regarding the current currency crisis, where a foreign exchange shortage of standing at $2.3 billion has squeezed essential imports including fuel, food and machinery. The move to approach the IMF for help comes after months of resistance from Sri Lanka's government and central bank, despite calls from opposition leaders and experts to seek a bailout package. On a more positive note, India's annual industrial output according to the Index of Industrial Production rose 1.3% in January compared to a 0.6% contraction in the same month in 2021. The manufacturing sector has been a key contributor to growth in the index as the sector grew at its fastest pace in 3 months. It grew by 1.1% this January, with the figure for December 2021 being revised to a growth of 0.2% from a contraction of 0.1%. This is in line with expectations, as Reuters polls indicated expectations of a rise in IIP by 1.5% in January compared to 0.4% in the previous month. Thank you for watching today's episode. So the question of the week this week is, Western governments have placed several sanctions on Russian oligarchs. Do you think it is fair to punish those who have close ties to Putin but are not directly involved in the Russia-Ukraine conflict? An example would be the sale of Chelsea and ticket sales being blocked. Is this fair on fans and a just course of action? Please let me know what you think, and I'll see you next week. Bye.